Investors Chronicle.
Welcome to the Companies and Markets Show. It's Tuesday, the 7th of November as we record. Scheduling issues mean we're a little early with the recording this week, so we'll have to trust to fate that nothing too significant happens between now and Friday. Anyway, I am Dan Jones, Deputy Editor at the IC, back in the hot seat today after 2 weeks across the pond, and we'll be turning to the US later on in the show to discuss this week's cover story, which is all about the world's biggest company, Apple. It's a stock that very few investors can completely avoid, and nor would they have wanted to over the past few decades, but it's arguably due a more testing time in the months ahead. We'll look at the new challenges it faces and ask whether the valuation still stacks up. We're also going to examine the fate of large companies in general, among other things, as we discuss another of our features this week, which looks at the possible limits to corporate growth. Before all that, though, we will be running the rule over Associated British Foods' annual results out this morning, in which news of Primark's relative resilience seems to have helped cheer investors. Joining me to discuss all of this are, first of all, two recent home movers, Mark Robinson, who's moved just down the road in his village. Hi, Mark.
Indeed. Welcome back, Dan.
Thank you. And heading further afield, Arthur Sants, who joins us over the line from New York, where he's now in situ as our US companies reporter. Hi, Arthur.
Hey, Dan.
And with me in the studio, Jemma Slingo. Hi, Jemma.
Hi, Dan.
Associated British Foods, then. We'll begin with them and with you, Mark. As I mentioned just now, the results have been received fairly positively this morning. There's a buyback in there. There's a special dividend. There's lots for investors to enjoy, in short.
Yeah, so warmly received, to say the least. The last time I looked, the shares are up by 6.8%, which is a pretty decent increase given that ABF had foreshadowed the results midway through September. There was progress across the board for the group as well on a like-for-like basis. Group revenues as a whole were up by about 16% to just under £20 billion, which management put down to pricing actions, and we'll get on to those in a moment. The group also, as you say, added a 12.7p special dividend to the final, which equates to a full year payout of 60p, or a 37% increase year on year. And there was a £500 million share buyback announced as well, another one there. If I was to summarize the results in one sentence, I would say that the group has prioritized revenues and volumes above unit profitability, although they didn't sacrifice profits in total. So yeah, it's a little wonder that the share price reacted so positively this morning.
ABF is, of course, a many-headed beast, as it were. There is Primark in there, as I mentioned. There's also the grocery business, the sugar business, the ingredients business is a slightly smaller scale as well. How are all of them, insofar as you can sum them all up quickly, but how are they all respectively faring at the moment?
Yeah, sure. I mean, a lot of the focus centered on Primark as well, because their sales account for just under half of the group total. Revenues grew very strongly, 17% there. And that reflected the point I made earlier, the fact that they decided to pass on only part of the input cost increases to customers. So you had a situation there where the operating margin in retail dropped from 9.8% to 8.2%. But Boss had said that because they've seen such a marked decrease in input costs and freight costs in recent times as well, they expect that to move above the 10% mark in fairly short order. So next year as well, Primark's going to be helped along with the fact that they're adding another 1 million square feet to their stores, and they're expecting modest levels of like-for-like sales growth, which is understandable given general economic conditions. And we should see an increase in unit profitability there because of those reductions in raw materials and freight costs. The grocery business, another good performance there, double-digit revenue growth. But again, they repeated this thing where relative profits didn't grow at the same rate. Now, this could reflect an inherent lag between input cost increases and the pass through to customers, or or like Primark, and I suspect it may. This could be the main reason. An explicit decision had been taken to sacrifice a degree of unit profitability in a bid to shore up those volumes. The sugar business was probably, but there was still a profitable. It was still a profitable period for it, and there was a really large increase in revenues. But that was, it's a commodities-based business, so it was down to higher sugar pricing. The contribution from sales prices was offset to a large degree by high costs for beet cane and energy, and specifically that meant that the company needed to buy and import sugar to make good on a shortfall in UK and European sugar beet production. So there you have it. It's quite an interesting. You wouldn't necessarily class ABF as a conglomerate, but there are a lot of moving parts there.
It's interesting you use that word, conglomerate, because we might return to that later on in the show. But let's talk about Primark. As you say, it's the biggest part of the business, and that margin reassurance, I think, has helped today as well. I'm sure the special dividend is doing a lot of the heavy lifting, but I think that helped investors who are concerned about whether that would get back to 10% plus, which they've said it should do next year. There's still the question of whether it can get to the older levels, I think, of more like 11 or 12%. But
yeah,
you talk about the volume strategy, which is maybe a little bit different to some peers or some consumer-facing companies this year, or in the past couple of years, who've been pushing through some quite big price hikes. It's undoubtedly working, though, and maybe that's in contrast with Primark, with some of the other low-cost retailers we've seen in recent weeks and months. This strategy is working.
Yeah, I mean, I was thinking in terms of the fast fashion retailers when you mentioned that too as well, because I mean they've been very high profile fails in recent times as well. But as you said, that Primark is essentially, it's a different proposition. It's based on value for money rather than any vagaries associated with the fashion market. In fact, in certain respects, and this will probably appeal to older listeners out there, I think Primark's place in the market is similar to what Marks and Spencer enjoyed in the 1970s and 80s, in that it was more or less the default option in terms of apparel necessities, socks, underwear, jumpers, that sort of thing. It isn't a fashion statement as such, and so from that angle, you would imagine that sales would hold up a little better.
It sort of strikes me as well. I mean, it's far too soon to say. Primark's had its up and downs. It's doing quite well at the moment. But, another company, which again we might mention later on next, in terms of a retailer who can do things through thick and thin, that's clearly the kind of business you would imagine that most retailers, most clothing retailers would aspire to be. Are there any kind of similarities there, or is that just me jumping from one good set of results to a company that's done it through thick and thin?
Well, actually, I've lost count of the number of times that people have been pleasantly surprised by Nex's results, because they seem to have outperformed the markets during periods where other fashion retailers. Let's not forget as well, they were slow on the uptake as far as online retail goes as well. But I think Next just provide an extraordinary example. I think they've been one of the stars of the FTSE over the last 20 odd years or 30 years, however long they've been going now. And there's no reason why that shouldn't change. But again, it's a value. I guess you could say it's a value proposition as well.
Indeed. One thing I think you wanted to pick up on is customer loyalty. And maybe if we just preface this by talking about the Primark margin again and the volumes, because a lot of companies over the past 18 months, maybe more so in the staples space in particular, but have been prioritizing price over volume. And as those pricing tailwinds for them start to fade, volumes become more important. So maybe the companies that are already putting the work in on volumes will be stood in better stead. But then I think you have some points to make about brand loyalty and how that feeds in as well.
Well, yeah, I just think, we're still in the midst of the cost of living crisis at the moment, although, as I mentioned before, those inputs are obviously coming down. We get that from different quarters. But I think people may need to recalibrate their assumptions on the subject of brand loyalty after we get through this period as well, because it must have been the first time in several decades since we've had such a lengthy period of price rises too. Now, if you look at a company like ABF, it differs from others. I mean, it has got some high-profile brands such as Twinings and Kingsmill, Patax, the range of curry sauces, but it isn't reliant on them to the same degree as other companies such as say Nestle or Procter and Gamble or in fact Unilever. Part of the attraction or the investment rationale for these types of companies is because the strength of their brands, and they provide a sort of an inbuilt moat, as it's sometimes said as well. And part of the reason there is because they were seen to be generally price inelastic. If you're going down to your local Tesco, you're not going to mind paying a few extra pence for a jar of Bovril or some Heinz salad cream. The strength of those brands engender sort of loyalty. However, given the lengthy period of inflationary pressure, there are signs that may be dissipating to a certain degree, and it's not just based on anecdotal evidence that I base this claim, but I've read a couple of articles recently, one from the Gross as well, which indicates that consumers, because of stretched household budgets, are increasingly likely now to look out for a generic alternative in many cases. And this also may reflect to a certain degree the influence of the German discounters. Now, whether this plays out over the long run when prices moderate is yet to be seen. But it's certainly, if you're invested in that space or thinking of investing in either household goods or food retail, it's worth keeping in mind. The only other thing as well that's worth mentioning, another change, not necessarily related to the inflation, but it's a knock-on effect from the pandemic, is that companies like Procter and Gamble and Unilever are reducing the number of brands that they're bringing to market. This came about initially because of the disruption to supply chains during the pandemic. It was they decided to build more reliable models in there, and I think they've found out since is that a lot of revenues and a lot of profitability comes from a relatively narrow band of products for all of these companies. So that's going to play out as we go forward as well. So anyway, just those two things are worth keeping in mind.
Indeed. Primark, slightly different, of course, in some of those aspects, but I think a lot of them still boil down to clearly the fate of the consumer into 2024, and whether they can keep spending on what they're currently spending on. But on Primark, on ABF, a final word maybe on valuation. The shares have had a very good run over the last year. That said, the PE ratio is kind of back to where it was a couple of years ago. So, how do you see the valuation case?
Yeah, I mean, as you say, the shares are up by about 56% over the last 12 months, including today's increase too. And hopefully we're reading from the same hymn sheet here. I've got them at a forward rating of 13.5 times. That comes with a dividend yield of 2.4%, which goes up to 2.7% when the special is included. That's that forward rating's at the top of the range over the past year. But by the same token, its PEG ratio has also improved there. So it may be that the rating could be justified by growth prospects. If you go back, it's interesting, there was a positive technical signal on the share price going back as early as the 4th of January, and it took off after that as well. But now we're in a situation where the short and long-term moving averages are sort of starting to coalesce. And that could imply that the share price may be losing momentum, at least on the short term. So, it's not screaming value at the moment. I mean, it definitely falls under the value heading, I think, in terms of if you're going to add it to your portfolio. But I'd say at the moment, probably everything's in the share price as things stand.
Well, let's move on now to Apple. which is our cover story this week. A deep dive into the company and its prospects. Arthur, you have written the piece. Now, clearly, well, why don't we start with the results that Apple itself had last week? How do they look? How has it fared this year? And then we'll get on to, the forward-looking case and some of the threats now facing the business.
Yeah, hi Dan. It was kind of interesting set of results because they beat their earnings were good, like profitability, but there was some disappointment, and the reason was because product part of the business, so wearables, iPad and iPhone, didn't do as well as expected, particularly because Mac and iPad were down a lot, but the services part of the business did better than expected, and services was much higher margin than the products part of the business. So that was good for profitability. So there's sort of, I guess it's like depends where you want to look at it, and it's kind of a microcosm of what the debate around Apple is at the moment, which is that the products part of the business, at least last year, was getting smaller. iPhone did all right. It was up slightly, but it's sort of, while the services side of the business is growing double digits and is really strong, product still makes up the most of the business. I think services was 22% last year for the whole year, and product was the rest. If services can keep taking a larger portion of the business, then profitability will grow. Its gross margins at like 70%, which is well above the sort of 40% group average. So I guess it depends sort of which way you want to look at it, whether it was a positive or negative set of results.
As you say, the services side, it's trying to put more focus on there because it is a smaller, albeit higher margin and growing faster part of its business. But the main overriding reason, I suppose, that it is trying to focus on that side is because the product side is slowing down. And, that's not necessarily a bad thing insofar as, the iPhone sales have really driven Apple forward for years and years now, haven't they? But then it may be that we're coming to the end, or potentially some people think we're coming to the end of that kind of growth phase. We can get into some of the structural reasons perhaps in a minute, but there are also some factors to consider in terms of China, for one, which has been a big growth market for Apple in the last few years, in particular with iPhone sales. Some other external factors which might mean that those sales and sales growth is harder to come by in the next few years.
Yeah, so the China point is interesting, and there's one very specific story around China, which is Huawei. So in 2019, when they put the sanctions on Huawei because of the worries about 5G, they stopped being able to use US suppliers for their phones, and they fell way behind Apple, and Apple stepped in and took up a bunch of their market share as the sort of high-end smartphone in China. And China last quarter was 17% of Apple's revenue, so significant, and the third largest market behind Europe and the United States. But in a couple months ago, Huawei released a new phone which had it's like a 7 nanometer 5G chip in it. Basically, it's like the first time and the most advanced chip they've been able to make under the sanctions, and they did it by using their chip manufacturer used one, which was Chinese based, used one of like the older ASML photolithography machines. And I guess people were shocked. They didn't think they were going to be able to make such a high-end chip, and they put it in their new phone. And that phone's been selling really well, the new Huawei phone in China. It was, and now the concern is that sort of Chinese patriotism, it was sort of hyped on Chinese internet as this big advance for Chinese technology. And Jeffries thinks that this is going to be bad for Apple, and their projections were so last year Huawei had a 7.7% of the Chinese market, compared to 16.8% for the iPhone in the smartphone market. But by 2026, Huawei is going to jump from 7.7 to 25% of the market share, while Apple's going to go from 16.8% down to 11% in 2026. At least that was Jeffries' projections. And because this new chip is being made on these older machines, the yield at the moment isn't that great. Basically, that means that they're making more chips that don't work. But the belief is that sort of once they get reps in and keep practicing making these chips, they'll be able to start being able to increase the supply. The issue for Huawei at the moment is not demand. People really want these phones in China. It's supply. But as supply goes up, that'll give them more capacity to take market share away from Apple. So China is a concern and could be a big headwind for Apple moving forward.
Yeah, we'll get on to some of the maybe more positive or potential positives in a moment, because of course, this is a company famed for its innovation and for, confounding the doubters perhaps. But with the iPhone as well, there is this separate issue of the replacement cycle, albeit this was something people were concerned about a few years ago, I think, back in just pre-pandemic, thinking, well, everyone's got an iPhone now, or everyone's got a smartphone, the market is pretty saturated, where is growth going to come from? Apple really proved them wrong in that case, partly through its own efforts and partly perhaps through the pandemic, which gave people a lot of extra cash to spend and allowed people to upgrade to 5G models, which, they hadn't upgraded their phones for a few years. And that really drove growth for the past few years. But now, again, it seems we're at this point where we're thinking, how many more iPhones or how many more iPhones in excess of current levels can be sold. And an additional concern is this replacement cycle and how often people want to or are capable of, changing their phones, upgrading them.
Yeah, so the question is whether smartphones will sort of follow the personal computer route, which was at the moment, as you can see with Mac sales, which are down significantly. Once everyone got a personal computer, they just stopped upgrading it as regularly. And if everyone has it and you're not upgrading it every year, growth would sort of slow. Like, you need to be upgraded unless you're bringing in new people, taking them from other companies, or you need people upgrading their products fairly regularly. And generally, it's the upgrade cycle is nearer to 2 years. Obviously, as you said, the pandemic, it's hard, kind of obscures what's going on a bit, because during the pandemic, people did upgrade their consumer electronics. They were on them a lot, and they had a bunch of spare cash, as you said. So the comparators at the moment are tricky. Like, if everyone upgraded in 2021, it means that 2023 was going to be a trickier year because everyone had up-to-date electronics. The analysts, I know Jeffries was saying that they seem to be leaning more towards the fact that maybe Mac and the was a possible sort of negative precursor, and that it sort of might head down towards that direction. There's like a sort of theory that each generation of computing produces more units. So, for example, if with personal computer, every family might have like one or two in their house, and then when we moved on to smartphone, everyone got their own smartphone, so it was sort of exponential growth. And then there was the hope that then people would all buy wearables, so they'd start having like watches and smaller computer items on them, and then that would cause a bunch of extra growth. But wearables is still a pretty small component of Apple's business. iPhone still makes up over 50% of its sales. So if they can't find extra growth there, then just compared to a decade ago when iPhone was sweeping the world, it's going to be trickier, at least, like especially against those comparators from 2011, 2012, 2013.
Yeah, in the recent figures, the full year results the other day, Apple's first revenue decline overall since 2019. iPhone struggles were an aspect of that. Clearly, it's such a big part of their sales still. I mean, there are some positives even on that front, I think, aren't there? There's the case that, there are still some people who are apparently needing to replace and coming up to doing so, and there's a new iPhone model out. There's also been a lot of talk about, younger generations in the US really shifting away from Android and towards iPhone more than older generations are, being even more of a status symbol, which could be a tailwind too. But the other potential positives we talk about in the piece are in part related to the services side of the business and what it's trying to do there and how it's trying to make sure that double-digit growth can keep, charging ahead.
Yeah, so I've been saying lots of negative things, but there are lots of positive things. They're the most successful company ever, so they're pretty good at making money. So they got this new iPhone that came out, and it came out in September, so it barely has had an opportunity to have a big impact on sales. So we'd expect the coming quarters to see how popular the phone is. And actually, I went into the Apple store here in New York earlier this week. I lost one of my earbuds and I needed it replaced. the experience was great. I was like super impressed, and they were all really friendly. And then I was chatting to the person in the shop and asking how popular the new iPhone was and whether I could get one. And most of the, apart from some like ridiculous colors, all of them were sold out. So, and the shop was rammed. So it's hardly like they're not struggling. And it's just sort of a question of valuations, which we'll get onto in a bit. But the good thing about the new phone, or at least what they're pushing, is it has a new chip, and they call it's an A17 chip, is what they call it, and that's a 3 nanometer chip. And if you remember, I said that Huawei's was a 7 nanometer chip, which means that Apple's technology is way ahead of theirs. And the main benefit of this new chip, which they design in-house themselves, which is important because it means they can line up their whole strategy in terms of they have their own software, the iOS. They now design all their own hardware. And going forward with AI, the hope is that it means they'll be able to create an AI app store, which is what one analyst told me. He thought it might happen as early as next year. And that means that if you're you're a developer and you want to create an app for the phone, you can go onto their app store, use their own AI model and create apps around that. And the benefit of designing their own chips means that they can make high-end chips that can do the sort of AI processing on the Mac or their iPhone. And also the main benefit of this chip that they have in this new phone, it's just been released, is it's really great for video games, which even if you aren't a gamer yourself, a lot of the younger generation obviously are. And as you said, it's becoming more popular with sort of the younger generation in the US. And if they can get more of the gaming community, that's only going to be a good thing. And it sort of ties into the services point, which is that services revenue is highly recurring. They get a massive wedge of all the sales that go through the App Store, towards 30%. They have some personal contracts with other companies, but it's a really high chunk. And gaming, if they can get more people buying games through the App Store and gaming on the phone, then that's going to boost their services revenue and increase the high margin recurring nature of that, which sort of dollar for dollar, those service revenues are much better than the product revenues because they keep coming in, and you don't have to worry about sort of cyclical nature that we've seen with their products division in the last year.
Indeed. We're going to need to move on shortly, but let's finish again by talking about valuation here. I mean, Apple, it's still a huge cash generator. It's still going to be generating vast amounts of cash. It has a big cash pile. These are all things in its favor. But when you look at some of the headwinds and when you look at the valuation, how does that valuation in and of itself compare maybe with peers and with recent history, and what can we learn from it perhaps?
Yeah, this is always the trickiest bit, isn't it? The thing about Apple is that they are expensive at the moment. Historically, they're 27 times forward earnings, which is basically as expensive as it's ever been. It was a bit higher during the pandemic, but only fractionally. And then when you look back to a decade ago, when it was trading in the teens, it's like much higher than it was then. And then you think, what are its prospects compared to a decade ago? I guess it's easier with hindsight to say that obviously this iPhone was going to be insanely popular. But back in 2014, the iPhone was still really popular. It seemed obvious maybe that iPhone was going to keep growing. And now Apple's worth a lot more than that. Yeah, it's had a year where it hasn't had any revenue growth. It's a company that can reinvent itself, right? And it did that before with the iPhone, and now it's trying to do that again has this new headset coming out as well, the Vision Pro, and the services part of the business. It's obviously, if that can go up from around a fifth or a quarter of the revenue, which it is now, up towards 50%, say, then suddenly the valuation probably looks a bit more reasonable. Compared to its peers, it's a little bit cheaper than Microsoft, which is on 30 times forward earnings. But Microsoft had a lot more growth last year and has a really tangible AI story that's already bringing in revenue. And its cloud computing division, Azure, grew 29% year on year last quarter. So Microsoft's a little less profitable in terms of sort of return on equity, but it's got a lot more top line growth. And then compared to Google, and then Apple's a lot more expensive than Google and Meta. They aren't like for like comparators, but Google and Meta are on 20 and 19 times earnings respectively. I would say that looking historically against a decade ago, it definitely looks on the expensive side. There's there's always a little bit of hedging, and Warren Buffett's Berkshire Hathaway has like a third of its portfolio invested in Apple. So I know people are loath to bet against him, but given everything that's going on, given all the headwinds, given interest rates are much higher, you just would expect its valuations to be a bit lower than they were in the middle of the pandemic, or not sort of double what they were a decade ago, I think.
Indeed. As I say, that is the cover story this week, so you can find out more on all the issues we've just discussed in the magazine and online as of Friday. We should, though, go to our final section of the week, and it does tie in with Apple because, as I said at the top, Apple is a stock that's hard to avoid even if you want to. You know, it's 5% of the MSCI World Index, it's 7% of the S&P, and that is a testament to its ability to, keep growing, to reinvent itself. Equally, it means if you're a passive holder of passive funds, you're going to have exposure. If you're a holder of active funds, you're going to have exposure because they don't want to take that much benchmark risk by avoiding it entirely. So the vast majority of investors will have some kind of exposure to it. And that is what happens when you are the world's largest company. Equally, Jemma, there are sometimes limits to growth, particularly if you are very large. You've been looking at that this week from a number of different aspects, not just the very biggest companies, but why don't we start with them, given we've just discussed Apple. Why don't we discuss this paper, the winner's curse, as it's called, the difficulty of staying on top?
So yeah, I came across this paper when I was doing some research for the feature, and it basically puts forward the argument that once you reach the very top of an industry, you're likely to start underperforming very soon. And it gives various reasons for it. So regulators might be out to get you. The smaller companies are absolutely out to unseat you. Or as Arthur was talking about in relation to Apple, it just gets harder and harder to grow once you get so massive. Basically, the report tracked over a number of decades how these top dog companies, as it described them, has changed. It's sort of identified this real churn at the top, which actually, it just makes you think maybe the status quo as we know it today isn't going to last that much longer. It put an interesting perspective on the market, which I hadn't really thought about before.
Yeah, in some ways, I imagine this is, the philosophy of the economic system in which we all live, right? In that, creative destruction can help these companies get to the top and it can help them reinvent themselves. But equally, it means there are always threats and always changes that we don't foresee, perhaps. And in 10, 20 years' time, there can be different companies at the top, and there usually are. But it's not just about the very biggest. It's also about the feature itself. It's also about how to sustain growth even at lower levels, and how companies can sometimes, attempt to do that by branching out into areas that cause them to lose focus, or areas with which they're not as familiar, and therefore things can go awry as well.
I think so. So when I'm reading companies' results, management teams are absolutely obsessed with getting bigger and bigger and bigger. And I think sometimes it is worth pausing and thinking, is actually that process of getting bigger always a positive one? So in the piece, I look at a few FTSE 100 companies, which are obviously very successful, very mature. But some of them have really come unstuck when they're thinking about future growth. So moving into America is often something that crops up, not just at the IC, as Arthur has done, but in company boardrooms as well. And I think that there's often this thought, well, the market's huge in America, we can make loads of headway, but often the execution risks involved are massive. So one of the companies I look at is Tesco, obviously a very large supermarket. Back in about 2007, it had this idea to move into North America, and it just was a complete disaster and completely abandoned by 2013. So I think there are these real execution risks once you reach a certain size. And it does seem, as you get bigger, the threat of smaller, more nimble companies just expands, really.
Again, it's an interesting point, isn't it? Because there are, clearly, if you're management, you want to grow EPS, you want to keep your share price rising, and to do that, you've got to show that growth and that expansion. But equally, as you point out, that's often easier said than done. Another example, perhaps, of where the execution risk meets with a valuation risk, if you're a company who's done very well and grown very fast, and you're trying to keep that going, is perhaps Rentokil, as we saw recently. It's digesting this big US acquisition, Terminix, and the business still seems to be doing pretty well operationally. but its valuation has been bid up over the years. And, it was just a few weeks ago when it made the first kind of hint of tougher times for that business in the US, in the market, which it's really expanded into with this acquisition. And that hit the share price very hard. And again, that shows perhaps, how much is at stake with these big deals and with moving into the US as well.
Yeah, I think massive acquisitions are a real tricky thing to know how to deal with when you're an investor, particularly a retail investor. And Rentokil obviously made this really big acquisition with Terminix, which is a pest control giant based in North America. And you can just see by the extremity of that reaction when it put out its Q3s and said, "Oh, the North American market's a little bit weak," that investors are still very nervous about it. And I think it's just hard to know when a company comes out saying it's making such a big purchase, to be able to foresee what will happen and how it will make all those cost savings that it's promising, how it will integrate the systems. But there is this big body of research, which I look at briefly in my piece, showing how M&A often pans out, and often it's not great. Obviously, we don't know whether that will happen with Rentokil, but it's definitely something to bear in mind when management teams come out with these extremely excited statements about how they're going to massively grow with this acquisition. I don't know, sometimes I think it should set off alarm bells.
We had our feature earlier this year, as you mentioned in the piece, the M&A masters, the ones who do the buy and build, the regular, perhaps, slightly smaller acquisitions, but yes, there's no doubt that M&A can be quite value destructive a lot of the time. To wrap things up and to bring things back to the beginning of the show, it was an interesting part you mentioned about Next. Next, normally has some interesting commentary, and they were talking about their growth plans, but also how they've tried to restrain themselves in some ways.
Yeah, so if any listeners follow Next, they'll know that it puts out huge company updates, even if it's just a half-year result. They put a big old document out there, which has a lot of self-reflection in it, really, which is helpful. And in its half-year results, it said it risked becoming an unwieldy retail conglomerate that lacks focus and agility. And I was really struck by that comment, because it was both quite frank and also quite accurate, I think, because it then went to look at various different companies that had failed because they got too big in the retail sector. And it's interesting to think about whether retailers are specific with that problem, the issues of growing brands and becoming too mainstream, or, I don't know, losing touch with their end consumers. But it was just an interesting comment, I think, and did make me reflect on the industry more generally. And yeah, coming back to Associated British Foods, thinking about how that will play out in future years.
Yeah, it did remind me a little of ABF. Clearly, it's, if you want to call it a mini conglomerate, if we don't accept the term as Mark didn't earlier. And, it's not just retail, it's more about the retail business and other sides to it. But, it rings those bells. But nonetheless, ABF, as we said at the top, is doing pretty well at the moment itself. So there are many ways to, for the cookie to crumble, shall we say. We have, though, reached the end of the show. So thank you very much to Jemma, to Arthur, to Mark, and thank you to you for listening. We'll see you next week on another Companies and Markets show.